so there's really several challenges that the industry faces. Probably the largest one is the lack of transparent pricing. So far, a lot of the transactions that have happened have been long-term offtake agreements, which don't really lend themselves to the same kind of transparency that we see in more developed markets. That makes it difficult for facilities that want to expand or for groups that want to build a new facility to obtain financing because it becomes a little bit tougher to put revenue projections together. In addition, the price itself is also an issue because what we've heard anecdotally from these long-term offtake agreements is that the price of SAF is about 2 to 3 times the price of Jet A, and that leaves a gap between the credit revenue that is generated from the production of SAF and the price. And so that will need to narrow to make SAF more competitive. However, as we get more production, that will probably narrow up a little bit anyway. The third is really capacity and production, which is kind of dependent on the first two. There have been a lot of announcements for SAF capacity, and I think a lot of the industry wants to go in that direction. And so I think that is that of the three problems, that's probably the easiest to solve. But from an analyst perspective, getting the timing of all of those down when people start and the level of production is something that is still in the very, very early stages. And so because of that, it goes very quickly, but from very small levels, and that makes it a little bit more difficult to predict. So really, the lack of production capacity that is installed and operating makes that ramp up period a little bit difficult to try and figure out. And given the decline that we've seen in profitability of renewable diesel production, we've had companies that have announced that they want to produce SAF, but they're going to pause a little bit or delay the opening of their SAF unit. Those kinds of shifts make it difficult to figure out exactly when the supply is going to come on. There are also a couple of facilities that are sort of purpose-built for SAF production that can turn on or turn off depending on the economics of SAF. And given the difficulty with the price transparency, understanding when those facilities come on or turn off is also one of the challenges. So the feedstocks that are used in SAF production currently are essentially the same feedstocks that are used in renewable diesel production because the HEFA pathway is the only pathway that the EPA has given guidance for the new IRA credits on. There are several other pathways that will come along that don't use the same kind of feedstocks that HEFA production does. And so as those come on, the feedstock mix will change, but currently it's the same kind of stuff that we see for renewable diesel. So used cooking oil, tallow, soybean oil, those are the main components of the feedstock mix currently for renewable diesel. And since SAF is on the same distillation tower as renewable diesel, those will be the same feedstocks that are used in SAF production. So one of the things that's happened over the last 9 months is the U.S. has started to import a lot more low CI feedstock than it had traditionally. Now, for me, an analyst, that makes putting a balance sheet together much easier, but it also comes with some risk. So currently, a lot of the low CI imports that we are getting into the country are tallow from Australia and used cooking oil from China. The tallow from Australia sort of highlights the risk in that as SAF programs start to propagate around the world, then some of those trade flows will probably reverse because I'm sure Australia will set up a SAF program and they will want to keep the value added to tallow from SAF production in the domestic economy rather than exporting the feedstock to the US. And so I think what you could have happen is the US industry continues to grow in part due to the availability of low CI feedstocks from these other countries, and those trade flows could reverse as those other countries start to establish SAF production. That said, then there are other countries like Brazil that will probably also have a SAF mandated at some point, but that are really large agricultural producing countries and probably will continue to export low CI feedstocks to the US. So feedstock prices have been really volatile over the last couple of years, and if you look back, the percentage increase in prices was very similar to the percentage increase that we saw during the build out of the biodiesel capacity. The decline from the highs is also relatively similar to what we saw in the biodiesel build out. And we're in a period now where actually volatility has come down. If you look at the realized volatility for soybean oil futures right now, it is below its long-term average. However, the growth in demand from biofuels has added a lot of usage for soybean oil. So while everything looks good right now, if we have these changes in biofuel policy in other countries that cause a reverse in trade flows, or if we have a period where U.S. crop production or crop production in other major producing areas, particularly in South America, isn't the yields aren't at trend line, then we could see volatility return in a very large way, because the built-in demand from biofuel feedstock has narrowed the sort of the extra that we have that has traditionally sort of kept the volatility for soybean oil relatively low. And soybean oil is kind of the primary price setter for the rest of the feedstocks. It's not 100% that way because the low CI feedstocks generate a little bit more credit revenue, but still in general you see the other feedstocks move in tandem with soybean oil. So if we have a problem with South American crops, or if again the trade flows reverse, then you'll see volatility come back in a very big way. You saw in the first week of July, you saw soybean oil rally 6 cents in about a week, which is much more volatile than it had been because of the hurricane in the Gulf. And that kind of move reflects the sort of the hidden upside price risk that remains in the market even as prices have come down and volatility has come down recently. Sure. So what we really try to do is get as complete a picture of the fundamentals as we can. And so we have balance sheets for all of the major feedstock producers, for SAF and the other biofuels. And what we really try to do in the point of a lot of our models is to look at these trade flows. We kind of see trade flows as the first step in our price forecasting process. It kind of tells us first initially, does the world have enough of this stuff, or does it need more of this stuff? If it has enough or sort of too much, then obviously prices are going to probably move lower, and then we do some steps after that to determine how much lower. If there's not enough of this stuff in the world, then prices are going to move higher, and then we take a look into the details of the fundamentals to really try and figure out how prices move higher and how high they might go.